The broadcast is now starting. All attendees are in listen-only mode.
Hey, good evening, everybody. This is Greg Klingler. We're just going to give it a couple more minutes for people to arrive. It looks like they're arriving en masse right now. We'll look to get started in about 2 minutes. I very much appreciate your patience. Okay, thank you everybody for joining me on this late night. I definitely appreciate your time. Hopefully what we'll do throughout the course of the next hour or so is we will answer a lot of your questions that you have regarding long-term care, the need for long-term care, and any other alternatives that you have available. I appreciate all of the questions you gave me preemptively. I think we can answer most of these questions regarding long-term care. We are going to touch on determining the need. We're going to touch on age limits. We're going to talk a lot about self-insuring because that's absolutely an alternative to long-term care. In addition, we will talk about care that is available for people who have some health issues, as well as people who may have missed the boat from an age perspective from the more traditional long-term cares. But before we get started, I do want to set expectations here. Long-term care, the industry, and long-term care, the product and the risk, it's complex. There are people who make a living simply on long-term care and long-term care alone. We could talk about long-term care for 8 hours if we really felt the need to. The reality of this presentation, though, is the goal is not to talk about necessarily long-term care and make you an expert about long-term care, but the goal is to let you taste test traditional long-term care as well as a lot of the other alternatives that we have available to figure out what questions you should ask next. The goal is to make you dangerous so you can take some thoughts and some ideas to an expert that you trust, whether it be a financial planner who is an expert in federal benefits, who also knows the federal long-term care program, or whether it's SCIBA. But the key is really just to make you dangerous, to give you enough information. Now, again, to set expectations, we're going to be talking about a lot of complex topics. If you become confused at any point during this presentation, that is normal. I'll do my best to unconfuse everybody throughout the course of the presentation. But if there's something that you have questions on, please feel free to reach out to us. We'll answer whatever questions that you have. Last couple of notes before we get started with the presentation. Talking about long-term care. Now, I'm the director of wealth management, and I work with members like yourselves a lot less now than I used to, but I still meet with about 100 different members, clients, people who need financial advice every year. And I can tell you, talking about mortality and talking about life insurance is always an easier conversation than talking about morbidity, the inability to care for oneself. That is a very difficult conversation to have, and I have to give everybody a pat on the back for taking the time to talk about long-term care because it is, in fact, a very, very important risk to understand. Now, just like any other risk in your financial portfolio, the question is, okay, can we accept this risk with the assets and the resources we have, or do we need to pass this risk on to somebody else? The truth is, for most federal employees, you have a pension, and that sets you above most private sector employees. So most people, at the very least, can partially self-insure the need that is the high risk that is long-term care. Now, the question that you have to ask yourself is, can I self-insure the entire thing? Or can I self-insure a portion and then just supplement the rest with a small, inexpensive, efficient policy? So those are the things that we're going to talk about. I'm going to give you as many examples as I can, but the truth is when we talk about cost, it's going to depend on gender, it's going to depend on health, and it's going to depend on age. So if you do want an example of a cost for yourself, you're going to have to talk to us directly, and we're happy to help in that regard. Okay, so without further ado, let us get started. Okay, what is GIBA? Many of you know what GIBA is. We are a nonprofit. We were started back in 1957 by NSA employees for NSA employees. And in 1957, we were founded with a very specific purpose in mind. And that was to fulfill the needs of our federal employees, our federal members. And back in 1957, it was term life insurance and it was health insurance. Now we fast forward 63 years into almost 64 years into the future, and those needs have changed. FEHB has come in, FEGLI has come in, and our members' needs have changed in accordance with that. So now we continue to do what we started back in 1957 to help out federal employees like yourself, but now we do it differently. We offer service-based help, education-based help. We talk about long-term care. We allow for financial planning. The goal is to get you from where you're at to where you want to be in the most efficient way possible. And that's what we take very seriously day in and day out. So how can GIBA help you? You can read the words on the page. The scholarship program that we have is a very popular thing that we hear a lot of our members talk about. But what I think really sets us apart is three very simple words. Expertise. Understanding the federal employee. All of our financial advisors hold the Chartered Federal Employee Benefit Consultant designation. What does that mean? It means we know the federal employee benefits very, very well. We can supplement and we can augment them very, very well. And we proved it by passing a series of tests, culminating in a final test. And we do pass a test every single year to prove that we are still on top of all federal benefits. And then we have experience. Our financial advisors have an average of 15 years of experience. And then lastly, it's motivation. I think this may be one of the most important things. At GIBA, we are a nonprofit organization. We were put on this earth to help our members and federal employees and contractors and the like. And we take that very seriously from a compensation and a conflict of interest standpoint. The goal is to make sure there's nothing standing in the way between the best advice possible and the member. And that's what we do from motivation and an incentive-based standpoint. So experience, expertise, motivation. All right. The last slide before we really get started with this presentation, just a brief list of our suite of products. As you can see on the left, these are kind of our original programs. Popular right now are our discounted auto and home insurance, our vision insurance that you can sign up for outside of open enrollment, our long-term disability insurance, not to be confused with long-term care. Long-term disability insurance protects against the loss of your income if you become disabled, whereas long-term care insurance protects against the high cost of somebody else caring for you. Long-term care insurance is obviously very popular right now in today's world, and pet insurance, among other things, very, very popular. We provide a discount to our members. Last but not least, our group term life insurance does compare with FEGLI very well. On the right side, it's financial planning. We can do all or any part of financial planning, from college savings, looking at your TSP, planning for Social Security, retirement planning, and everything in between, including leaving a legacy for your heirs. All right, so I've done over the last 5 years about 100 presentations throughout the Maryland, Virginia, and DC area. And if you've ever seen a presentation that I've done in the last 5 years, you've seen a slide that looks kind of like this. And I think it's very important to just quickly talk about what this slide means. So we're talking about long-term care and the alternatives around long-term care in this presentation. But what I want you to focus on is not necessarily the facts of what we talk about, but how it affects you. For instance, if you're part of the old pension programmers, so let's say you're a CSRS pension person or an FSRDS person for our foreign service friends, those people have very large pensions. They may be able to self-insure a long-term care need simply because of that pension. So that's going to change what a financial plan looks like for that person versus a newer pension person who is part of the FERS program or the FSPS program if you're a foreign service person. But you also may be part of the 50,000 people who currently count themselves as TSP millionaires. Putting that together, again, we may be able to self-insure against the need. So everybody's different. So just think about how it affects you as we talk about the alternatives. All right, so why long-term care? Why is long-term care such an issue? Why have I said many, many times that over the next 20 years, the cost of long-term care will ruin what would effectively be a good financial plan otherwise? And the reason is because it's a high probability of need. Depending on what study you look at, between 50 to 70% of people age 65 are going to need long-term care. If you go into a home, the average stay for a man is 2.5 years. The average stay for a woman is a little bit higher than what's listed on the slide, 4.1 years. And then we have the expense. Now, I want to be very clear with you on this because this is very important. Where you retire is very important when we're determining what is the risk of the cost of long-term care. And it can vary very dramatically. The median cost in Texas for a semi-private nursing home is in the upper $80,000 range. Whereas, as you can see right here on the slide, in Washington, D.C., it's $137,000. So that's about a $50,000 swing. So where you retire from a financial planning standpoint, not just considering state-based taxes, but also the cost of long-term care is very important in the decision-making process. All right, so we've talked about the best case scenario. You don't need long-term care. Depending on what study you look at, between 30 and 50% of people will not need long-term care. We've talked about the median. Women spend about 4.1 years. Men spend about 2.5 years. So just to round out that conversation, let's talk about worst case scenario. Now, I'm going to say worst case scenario with a caveat here, though. Medicaid doesn't track how much they spend per person. Retirement communities, they don't advertise the largest amount of money that somebody's paid into their community. The only industries that love counting things and love advertising the counting of things is insurance companies. So these are the largest claims that insurance companies have paid. A male, about $2.3 million and growing. This was as of the end of 2018. A woman, about $2.6 million and still growing. Now, this is just for discussion-based purposes. Under no circumstances would I ever recommend planning for a cost of long-term care that's as high as $2.3 million. The point I'm trying to make, though, is you've been given the median, and depending on your current health and depending on your family history, it's up to us to decide, should we plan for the median? Should we plan for lower than the median from a cost perspective? Or should we tweak up the median a little bit and plan a little bit more conservatively, adding a little more money to the pot? That question is going to be almost entirely dependent on the information that you provide the professional that you're working with. All right, as I said in our preamble, I deal with about 100 members per year now. Before it was a lot more than that. But one of the questions that everybody asks when the concept and the topic of long-term care comes up is, okay, can I self-insure? Nobody wants to be insurance rich. We want to enjoy the money that we spent so much time and effort earning. So let's talk about self-insuring. So now we have to set some assumptions in place when we talk about self-insuring. So let's assume current age is 55. You're going to need long-term care at 85, which is about the standard. The current cost of care is $137,000. Again, that's the Washington, D.C. area. In Texas, that number is going to be a lot lower. The number of years of care is 4, very conservative for a man, a little bit light for a woman. and the assumed increased cost of care is 3%, which is pretty accurate for the Washington, D.C. area. If we assume a rate of return of 5%, you would have to put aside $310,000 per person in order to provide that level of care covered at 100%. So if you can put aside $620,000 for a couple and not have to worry about funding your retirement, then we can have a very, very serious conversation of self-insuring and not buying long-term care insurance. The truth is most federal employees can self-insure a large portion of the risk, but they do need to supplement or augment the rest with a very small policy of some kind. So how do you pay for care? Again, we talked about using that large pension or the pension that's different than your private sector counterparts. Using that thrift savings plan. Are you a member of the TSP Millionaires Club? It is very much a growing group. Do you have extra money in savings? Do you have a second property that you could sell? Those are all ways that you can go about funding and self-funding the long-term care need. Another item that I just quickly mentioned in the preamble is the idea that long-term care, it's a scary thought. People don't like talking about it, and human nature says we avoid what we don't like talking about. But the truth of the matter is, ignoring the problem is not going to make it go away. A failure to plan is a plan to fail. So before your retirement plan is done, you must look at the risk that is the high cost long-term care and come up with a plan, whatever that plan may be. The other question that everybody always asks me when we talk about long-term care, assuming that they decide, yes, I got to move forward, I need to supplement some of that risk with some sort of policy. When should I apply? Now, I wish I had a crystal ball for everybody, but the unfortunate reality is I do not. I can tell you that the longer you wait, the higher your percentage for declination, being declined. And that's because health gets a lot more variable. I can tell you're healthy until you're not. I've worked with people who've waited to buy long-term care and then suffered a chronic disease, and then were no longer insurable. I've worked with people who made the decision to buy long-term care, and very soon after they were approved, they suffered a long-term permanent condition. We're just guessing on when the best time to buy is, but I can say the sweet spot for typically buying a long-term care policy is in the early to mid 50s. All right, so let's quickly talk about traditional long-term care. I just want to tee up the traditional long-term care policy, and we'll give you some examples on what the costs are for both singles and couples, and then we'll mirror that against the alternatives available to you. All right, so what are the 5 moving parts about long-term care? The first one is the benefit amount. Is it daily or is it monthly? Now, typically when I'm standing in front of a crowd, I do ask the question, what's better, daily or a monthly benefit? And at this point, most people look out at me and I get murmurs, daily, monthly, but nobody really knows. So let's quickly talk about it. From a financial advising perspective, I like flexibility. Flexibility does make my job easier as a financial planner. Most people like to live in their home as long as they possibly can. Nobody wants to go to a nursing home. And home care is notoriously variable when it comes to costs. So let me just give you a quick example. So we have Monday. Let's say Monday's an expensive day. You have 3 doctor's appointments. You need somebody to come in and bathe you. You need somebody to come in and cook for you, take your medication. Monday's a $400 day. And let's say Tuesday, most of the things were taken care of on Monday. So you just need somebody to come in and cook for your food and get your medicine set up. Tuesday's a $100 day. And let's say on Wednesday, your daughter gets off work and she comes and takes care of you, and Wednesday has no cost. Having a daily benefit means you're probably going to have to come out of pocket on that expensive Monday, whereas having a monthly benefit allows you to average out the highs and the lows over the course of the month, giving you more flexibility, particularly if you're living in the home still. Next is the benefit period. That is the amount of time where you can burn through your monthly or daily benefit amount. If anybody has heard the federal long-term care people speak, they do a really good job with the metaphor. They call this the gas tank. So benefit period, times the benefit amount. That is the total long-term care benefit you have at your disposal. And you can spend that as quickly as the benefit amount states. You cannot spend it any more quickly than that. If you spend it less quickly, you will be able to use it for a much longer period of time than the benefit period. We generally recommend what's called a short fat plan. So large daily or monthly benefit amount, relatively large, but a relatively shorter benefit period, because if you do need the care, you can burn through it faster, but typically it's going to last the same period of time. Next is an elimination period. 90-day elimination period is generally what I recommend. It seems to be the strongest bang for the buck. It also is something that we can plan around, having effectively covering 3 months of care prior to going into a facility from a resources standpoint. Lastly, we have the inflation method. Now, to be honest, I don't really care how much long-term care insurance costs right now, other than using that number to inflate up to when you're going to need it. And I really don't necessarily care how much coverage you have today. What I care about is how much coverage you're going to have when you need it and how much the cost is when you need it. And that's where taking an inflation method is so important. Now, years ago, a lot of people bought 5% inflation methods because long-term care was rising from a cost perspective at about 5% per year. Today, in most cases, especially the more expensive areas, 3% is going to get you where you need to be. Now, if you're looking to take long-term care in Texas, which is a much cheaper area, then you should look at a percentage at 4 or 5. But in most cases, 3% is going to be all you're going to want to look at. And then shared care. This is just a nuance to a long-term care policy. It allows 2 people to each buy, they have to be a married couple, to each buy a long-term care policy. If one person exhausts theirs, they can then dig in to the second person's policy. Anything left over is still available for the second person's policy. Again, as a financial advisor, I really like options. I really like flexibility. Shared care provides that, but not without a cost. All right, so let's give you a quick example. This is singles, just to be clear, singles. So we make some assumptions here. We have $200 daily benefit. We have 3% compound inflation. We have 90-day elimination period. And just for my purposes, let's just keep it simple. Let's look at 4 years. A male is going to cost, for this policy, $2,180 per year. A woman for a comparable policy, $3,300 per year. Now, it's at this time where I'm generally standing in front of an audience and I see a lot of eyebrows raised, mostly women. Why is it so much more expensive? Well, statistically speaking, women spend longer in long-term care facilities. So statistically speaking, women are a larger financial risk for insurance companies, and that's where we see the premiums between male and female diverge. But it's not all bad news for females. From a life insurance standpoint, because women do live longer, life insurance is cheaper. Now, I do want to point out, if I do have any single females in the audience and who's looking for long-term care, the federal long-term care plan, which again, keep it, has no affiliation with the federal long-term care plan, it is still gender neutral. It's the same cost for women as it is for men. So if you're a single woman, that's where I would first look if you're looking for a long-term care policy. But for women who are married, we have a lot of discounts associated with being married. Or for men, single or married, there are a lot of options on the individual front. So let's look at a couple purchasing insurance. Now, I should start off by saying that the rates that I quoted here today are rates associated with a heterosexual couple. And while the discounts are absolutely present for same-sex couples as well, the truth is more heterosexual couples apply for long-term care insurance. So I'm just leaning to the majority here. But if you are a same-sex couple, please give us a call. We're happy to run whatever quotes that you need for your particular needs. All right, so In this case, heterosexual couple, husband and wife, they both purchase a policy. Let's again look at the 4-year policy. The cost for both people for a 4-year policy, comparable which the slide before was talking about, is basically $3,300. Let me go back to the last slide real quick for you. $3,300. That is the same price for a single woman alone. Why is the price so much effectively lower for a couple? Well, there's 2 discounts associated with a couple. First, just simply being married. Insurance companies have done a lot of research, and they find that if you're married, you're less likely to go to a nursing home because you don't want to leave your spouse. You're less likely to go to a nursing home because your healthy spouse may be able to take some of the responsibilities of caring for you. And for those reasons, they're able to offer you a better price. So now, full disclosure, the company that I went with in the first slide before this and the company I went with this slide, they're very similar from a credit rating standpoint, but they are different companies. We lean into whatever company works best for our members. We work with about 12 companies directly from a long-term care perspective and about 50 companies directly from a life insurance perspective. One other item to note on this particular slide is the Share Cared plan. For a little under $300, you have the ability to now take those 2 plans and allow you access to, once you exhaust one, to start using the other. Let me just give you a then and now example of a shared care plan. And let's just quickly talk, this is a great case study, talking about the plan, if there's any changes we should make as well. So the plan was purchased, and this was an actual plan, January of 2007. Male was 57, woman was 48. They had benefits of $4,500 for each person per month. The premium for both people was $31.61 per year. The coverage was 4 years for each person for a total of 8 years, and they did have a 5% compound inflation for life. Their benefit pool, their gas tank, if you will, was $432,000. All right, so fast forward to January of last year. That 5% had grown that pool very dramatically. The monthly benefit was now $8,485 a month, but the premium had risen. One of the major issues that people have with long-term care is the fact that the cost of long-term care can go up. Now, actuaries do predict that the cost will go up a lot less than it had in the past, but in this case, it did go up. It did get more expensive. But the inflation rider took the coverage amount and also made it much, much more expensive. So now we have $8,485 times 96 months, or a benefit pool of $814,000. Now, in this particular case, this is a very large policy, especially for federal employees. This, in fact, is larger than most federal employees will ever need. So if I were to run into this policy today, one of the steps that I would take is actually either reduce the coverage amount on a monthly basis or reduce the 5% compounding to something a little bit more accurate to today's world, and ultimately reduce their fees as well. All right, so now let's move on. We talked about traditional long-term care. Now let's talk about alternatives. Why are alternatives so popular? Well, I can tell you that there are certain stressors that involve people who know they need long-term care insurance from not buying it. One, use it or lose it. What happens if I don't need long-term care? Because some people won't. What happens to all that money that I paid in? The next one is cost increases. Almost everybody who's been to one of my long-term care seminars has a friend or has a friend of a friend who had the federal long-term care program in September of 2016, and the average premium went up 83%, with some people with lifetime benefits seeing increases as high as 126%. Those are scary numbers for people who are retirees, who are on fixed income. And people don't like question marks, and the potential for rate change provides question marks to long-term care ownership. Now, with that being said, actuaries say that there's a 10% chance that premiums will go up more than 10%. Most of the increases that need to be baked in have already been baked in. The truth of the matter is, back when long-term care was sold in the 80s and 90s, there just wasn't enough information, and the actuaries just frankly made bad assumptions. We're very, very close to making accurate assumptions now. But with that being said, is there a way to avoid use it or lose it? Is there a way to avoid the costs going up? And the very simple answer is yes. Most of these alternatives are life insurance based. They're built on a life insurance chassis. And the great thing about life insurance is if you don't need long-term care, it pays out in the form of life insurance. And we know that there are not a lot of guarantees in life, but death is one of them. So we avoid the use it or lose it. Somebody you love is going to get paid. Second item, will it go up? Life insurance is what's called non-cancelable. Now that's just a technical term for the price can't go up, and they also can't cancel you as long as you're making your premium payments. Long-term care insurance is what's called renewable. It's going to work a lot like your auto and home insurance. They can't cancel you per se, but they can raise your rates from a class perspective. And then after we talk about that, we're going to talk about things that if you had missed the boat for long-term care, if you missed the boat because of health, because of age, because of cost, we'll talk about things that could get you through a year or 180 days. It's not quite as comprehensive as the other items, but it's something. All right, so if I were to circle one slide in this presentation and tell you this slide contains the most valuable information when choosing long-term care, this is the slide that I would circle. So let me just explain how this works. So at the top of the funnel is the biggest long-term care benefit bang for the premium buck. And as we move down the funnel, we're going to reduce our long-term care bang for the buck. We're also going to potentially, the premium could change. As we move down the funnel as well, we're going to reduce the comprehensiveness of the medical questions, of the medical exams. So for people who are in not as great health, who are older, you're going to have a lot better chance of getting involved in the things that are lower on the funnel. Hopefully that makes sense. Still at the top of the funnel is traditional long-term care. That is the biggest long-term care benefit bang for the buck. But with that, you do have the potential for use it or lose it, and you have the potential that it could go up in cost. Moving one step down, linked life long-term care. When you see that, I want you to think little life insurance, big long-term care. It's still built on the life insurance chassis, so it's not going to go up in cost. And there will be a death benefit if you don't use it for long-term care. So little life, big long-term care. Moving down the list, linked annuity long-term care. If you want to simply just annuitize, get income for life, it will give you income for life. If you fulfill the need or fulfill the definition of needing long-term care benefits, which is you have the inability to do 2 out of 6 activities of daily living. An example of an activity of daily living would be transferring from a chair to a bed and back again, taking medication, bathing, continence. Those are all examples of activities of daily living. If you can't do 2 of those, you become eligible for a much, much larger annuity, typically times 3 or times 4, depending on your age of the original annuity. Moving down the list, and this has been the most popular across the board for our federal employees. Life with a CI rider. CI stands for chronic illness. So with this, I want you to think big life insurance policy that you can spend early for long-term care. Anything that is left over is still used for life insurance. And then below that line, typically I draw a nice hard line across it. For those people who missed the boat, then we have short-term care, home health care, fixed income annuity, and the SPIA. All right, so let's give you some examples. So male age 55, married. This is a life insurance with a long-term care rider. So that's the second one from the top in our funnel. The premium is a one-time premium payment of $50,000. Now, one of the nuances to these type of products is they do require a large amount for buy-in. So in this case, one-time payment, $50,000, and then you're done. If you don't have access to that kind of money, and many people don't, you can pay into this for up to 10 years. If you want your money back, you're not going to get it all back, but it will give you a return of premium of $35,000. At age 85, if you pass away, $57,000 in death benefit. But the real benefit is the long-term care benefit pool of $630,000 if you do need it. If you don't, again, it reverts back to the death benefit. So again, little life insurance, big long-term care benefit, does require a pretty large upfront premium. All right, so now we have two people. So buying a life insurance policy on two people with long-term care benefits on two people. In this case, male and female, age 55, married, best health. They put in upfront $100,000. And with this particular product, it also requires them to pay an annual cost for rider, effectively annual cost for the extra long-term care insurance, $1,887. Because this is life insurance, that will never increase. And if they want to pull out and get their money back, they have a return of premium of $35,000 per person, or a total of $70,000. At age 85, the death benefit is $121,000, so a little more than we started with. And the long-term care benefit is $572,000. Now, at this point, I generally get at least one hand raised, and they ask the question, if I put in $100,000, why is the long-term care benefit pool lower than the previous slide? Well, a simple answer is because the probability of 1 out of 2 people going into a long-term care facility is higher than 1 out of 1 going into a long-term care facility. That's the simple explanation. All right. Next one is the annuity with the long-term care rider. Again, it requires a pretty large upfront payment, in this case, $100,000. There's an annual premium cost each and every year, $1,551, never to increase. And at age 85, it's going to generate $300,000 towards a long-term care benefit. If you don't use it, the annuity value will be given to your heirs minus what was paid in claims. Also keep in mind this slide, as well as the next slide that we're going to talk about, takes into account people who are age 65. So this is older than the examples that we've been making in the previous slides. Typically speaking, the annuity with a long-term care rider is designed for people a little bit older than the age 55 to 60 range. All right, so now this is the most popular one that I've seen with our membership. Frankly, because most of our membership, when they retire, they have a life insurance need as well as a long-term care need. This fills both. So with this, again, think big life insurance policy that you can take out early. In most cases, you can take out up to 4% of the total death benefit per month. And that's going to generate, in this case, $10,000 a month for long-term care, assuming a $250,000 death benefit. This also happens to be the only product that I've gone through so far where women are cheaper than men because, again, this is life insurance first. All right. So now, for people who have traditionally missed the boat for some of the more comprehensive alternatives and traditional long-term care, we have short-term care policies. This will cover you for up to a year. It'll provide payment for a nursing home up to $200 per day, payment for home care up to $1,200 per week, and the annual cost is $1,425. Moving down the list, we have home health care. Now, for people who struggle with health issues or have aged out of other plans, This is available for people ages 41 through 85. And typically, there is only one medical question. Are you physically unable to perform your activities of daily living? So, bathing, eating, continence, transferring from a bed to a chair and back again. If you are, then you qualify for coverage. Now, if you're in New Hampshire or Alabama, you have one more question, and that is, do you currently receive home health care services? These are typically, for anybody reasonably healthy, very easy hurdles to cross when it comes to getting care. The cost, in this case for a 65-year-old, is actually very doable. We generally recommend the home health care with extra benefits because most people are on prescription drugs at that point, and the benefits of having the extra benefits, as well as the annual physical, the vision exam, more than pay for themselves. The home health care can provide up to $300 a day for up to half a year or 180 days, and for non-medical home care, $80 a day. All right, so the last one, this is kind of your last resort when it comes to looking for care. This is effectively prepaid care. It is not available in all locations. It is not available in all states. But what it allows you to do is it allows you to pre-purchase care with effectively no medical questions and a 90-day wait. So this is how it works. You buy a plan with a fixed number of home healthcare service hours. In this case, 600 hours. You must wait 90 days until you can start using it. Once you start using it, you can go through it as quickly or as slowly as you want. Once you exhaust that number, you have to wait 90 more days, and then that 600 hours comes back, and it'll come back 9 times for a total of 6,000 hours. And we look at the annual cost of about $3,363 per year. That is incredibly cost effective. A couple of years ago, we actually signed up my wife's grandmother for this, who is currently 96 years of age. So very helpful, and we're using it now. But again, not available in all states, but as a source of last resort, this can be a very powerful option. All right, so how do you select a plan? We talked about where you receive care. That's very important. If you're receiving care in the United States versus international, in most cases, traditional long-term care plans do not cover international care outside of Canada and the UK. You have to go with either an indemnity plan or the federal plan, which again, GEEP is not associated with, are options if you're going outside of Canada, the United States, and the UK. But with that being said, even where you receive care in the United States plays a big role. Not on necessarily the type of plan you should buy, but the amount of coverage that you should choose. What plans do you qualify for health? What are your preferences? What product does the shared care make sense? And review your numbers to ensure that you have coverage. Now, the key with federal employees is very simple. You need to make sure you are covered for what you need. So you want to review those numbers. I know a lot of insurance agents out there that sell a $5,000 monthly benefit plan to everybody. That may be the right number, but traditionally for federal employees, that is generally too high. It's about what you need and no more. All right, no discussion about long-term care would be complete without talking about reverse mortgages. People do bring this up. It is your equity. You have the right to use your equity in any way that you want, but I generally do not consider reverse mortgages a plan A. I consider reverse mortgages more like a plan D. And let me tell you why. Because banks cannot kick you out of the home when you start a reverse mortgage, and because banks are in business to make money, they put a lot of limitations on how much you can spend. They create a reserve that effectively is designed to protect the bank, and they have high costs as well. So let me just give you an example. We have a couple who is age 68. Both are age 68. They have a home that's paid off that's worth $500,000. Their funds available is about $240,000. The reserve that the bank requires to protect itself is about $240,000, and the total fees associated with a mortgage are going to be about $20,000. So a couple age 68 who statistically have a good chance of living for 20 more years can get about $1,000 a month. Is it something? Absolutely. Is it game-changing for most retirees? Unfortunately not, which is why it's a Plan D. All right, so the last item that we're going to talk about is the continuing care retirement community. And let's throw finances aside just for a quick moment. At GIBA, we have a lot of members who are between the ages of 60 and 102. We've seen a lot of people move through retirement in the golden years. And one of the things that I can say just from a qualitative standpoint is unless you have a very strong familial unit, people in continuing care retirement communities typically are happier because they're able to go into a care facility when they're young and healthy, or relatively young and healthy. As they need care, it's provided to them on the spot. As they need more care, it's provided to them on the spot. And if they need a full-blown nursing home, it's provided to them on campus. This allows them to continue to live their lives, spend time with the people they care about, maintain their friendships, stay with their spouse, and we just find that to be much more satisfying. Now, the question is, okay, how do we pay for this? Continuing care retirement communities come with two general types of costs. One is an upfront buy-in. And I've seen recently upfront buy-ins for as low as $170,000 to as high as a 3-bedroom in Silver Spring for about $700,000. Now, nobody really needs 3 bedrooms in a continuing care retirement community, but if you have the money. Most people also use the sale of their primary residence to pay for that incoming cost in a continuing care retirement community. And then as you need care, the costs are going to continue to increase on a monthly basis. When you first get in, it's going to look and feel a lot like a very high HOA. As you need care, it's going to start looking more like assisted living at maybe $3,000 or $4,000 per month. The question is, okay, how do you pay for this? Does it make sense to pay for it? And at GIBA, we've helped a lot of people generate the income and in some cases the initial buy-in to make it work, to give them the retirement that they deserve. All right, so which solution is best for you? We've talked about a lot of different solutions, and I really haven't gone into depth on any single one. Hopefully, I've raised your interest to a lot of these different solutions. So self-funding, every federal employee should at least be able to self-fund a portion of the risk. Traditional long-term care, life insurance-based long-term care, annuity-based long-term care. You can potentially rely a little bit on Medicare, where the first 20 days are covered if you've been put into a hospital for 3 nights. Most federal employees do not get to the point where they need Medicaid, just for your reference, though. So which solution is best for you? And for that, if you don't have a trusted financial advisor who understands the long-term care world as well as the federal long-term care program and federal benefits, GIBA is here to help. That's why we were put on this earth. We take it very, very seriously, and we're happy to help in any way that we can. So before I get to questions, as you leave this presentation, please do me a favor. There should be a survey that's pushed in front of you. Please answer that survey. Our seminars are only as good as the people who came before you and the notes they left. We do take those notes very seriously, so please let me know how I did. All right, so I'm going to open up the floor to questions. All right. Are long-term care premiums tax deductible? The answer is, in most cases, they are. Certain tax deductions are based on states, but in most cases, long-term care premiums can be tax deductible. Definitely talk to your accountant about that, though. Has COVID changed insurers who offer long-term care? In my experience this past year, COVID has not necessarily changed who is offering long-term care. All the same players are still in the industry, but what they have changed is how they go about underwriting. From a life insurance standpoint, a lot of things that it used to be done in person from a paramedical exam perspective, many of those are now done remotely with doctor records. From a long-term care perspective, there was a very brief time where some of the primary long-term care providers stopped underwriting, but that was back in June of last year. I haven't seen any other changes at this point in time. My sister spent $200,000 for 4 years for my mother. What would be the best option? Well, I guess that's a bit of a layered question. For your mother, because she's already in a facility, obviously, there's really not a lot we can do there. Although some of those last alternatives that we discussed could potentially be options, and particularly the prepaid care, the last alternatives that we talked about. If you're talking about for yourself, $200,000 over 4 years, that sounds like assisted living, or that could be home care. It just depends. So if you are looking for yourself, my first suggestion would be do a financial plan with somebody that you trust. Figure out how much you can self-insure and just kind of maintain coverage for what you can't, if there is anything that you can't. How do we get a copy of this presentation? You will be receiving if you gave us your email, which I believe you had to when you signed up, you will receive a copy of this presentation from a slide perspective. On our website will also be a video recording of this presentation as well. All right, can you describe an indemnity policy? So there's two types of policies out there. There's the policy where they are going to cover what you paid. That's most traditional long-term care policies. And then there's an indemnity policy. An indemnity policy is going to give you a fixed amount just because you meet the definition of deserving a fixed amount. Indemnity policies typically are more useful internationally because most long-term care companies don't want to deal with currency exchange rates. So if you meet the need, they give you money. In some cases, definitely look at the fine print. But that's generally how an indemnity policy works. Also keep in mind that most big life insurance with the ability to use long-term care early, those are also indemnity policies in nature. So if you meet the need, you get paid whether you paid the money or not. So that can be beneficial for heirs if you're looking to pay them for their work and they're not professionals. Does the federal long-term care only cover spouses or federal employees? The federal long-term care will cover spouses, and again, no affiliation with GIBA, just to be clear, will cover spouses, will cover yourself, and actually you can get your parents coverage as well through the federal long-term care program if they qualify. There is medical underwriting. One of the issues with the federal plan, though, just keep in mind, is it is a group policy, which has a lot of benefits, but the underwriting is much more stringent. It's typically pass-fail. If you pass, it's great, but if you fail, there's no like increased cost for somebody who's one rating lower. That's when you have to go to a private sector policy. All right. Effectively, somebody asked, can you get more than one plan? Yes, absolutely. What we find in many cases is stacking plans can be the most cost-effective alternative, both on a life insurance standpoint and in some cases on a long-term care standpoint as well. Do long-term care policies ever go out of business? Well, the truth is there's no guarantee that insurance companies in general will not go out of business, which is why it's so important to look at the credit rating of the companies that you're working with. I have not seen any major long-term care player go out of business. I've seen them leave the business. Genworth was a very good example of that. They were one of the primary providers of long-term care back in the early 2000s. They're absolutely keeping all of their policies. They're paying all of the benefits, but they're just not selling long-term care policies anymore, and they haven't been for years. But I have not seen any go out of business. That's not to say that companies don't, because unfortunately some do. There are protections at the state level with state guarantees that do provide some protections. But again, life insurance, long-term care insurance, any insurance is a piece of paper and a promise. You want to make sure the company that's making the promise is worthy of your money. All right. My brother worked for and retired from a 3-letter agency. I have some GIBA benefits through him. Can you help figure out a plan for me? Am I eligible for that? Yes, so GIBA does have a sponsored family program. When it comes to doing financial planning, one of the things that we do take pretty seriously is we want to make sure we understand who you are and the resources that you have at your disposal and your needs before we make any recommendations. That's kind of the standard when we work with anybody. So to your question, absolutely, we can work with you. Absolutely, we can figure out what you need. And we can absolutely find a solution that meets the need and only the need. Just give our office a call. If you have somebody you're comfortable working with, by all means, talk to them. If not, we can set you up with one of our other very strong financial advisors. All right, if you and a spouse have a shared care plan and one starts using the benefit, does the premium stop for both? Oh, that's a great question, a question that I did not cover. So generally, the answer is no on a stripped down, plain Jane policy. But when you purchase a policy, there's lots of different options you can choose, one of which is the waiver of premium, which is actually pretty cost effective. If you choose the waiver of premium, if one person goes on claim to a dual policy, then yes, the premiums will be waived from that point forward. Again, lots of different options on the long-term care front. Typically, if you have a thought, there's probably a policy out there that provides that nuance. But yeah, to your question, yes, there is the ability to waive premium. You just have to pick it. And it would be for both if it was a single policy. There are two different types of shared care policies. One is actually a single policy covering two people. The other one is two separate policies. The two separate policies would only waive the one premium. All right, so that covered every question I believe that was entered in the chat box. Let me just quickly review any questions that were given prior to the presentation. What is the minimum long-term care coverage a person mid-career should have? Well, mid-career, typically that's a little early for most people's long-term care. Not to say buying it's a bad thing, because it's certainly not if you can afford it, because the premiums are going to be very, very cheap. But I would look at long-term disability insurance first. Make sure you have that. The pension program does have a long-term disability aspect to it. Through FERS, it's 60% for the first year, 40% thereafter, which is very, very good, but that is a taxable amount. So once long-term disability, basically coverage for your loss of income, is taken care of, then if you can afford it and you're making appropriate contributions to your TSP or your 401k, then yeah, absolutely, the long-term care could be an option. But again, I wouldn't make that a priority mid-career. All right. We had long-term care through GIBA a few years ago, and the premiums became unaffordable. Were there any changes made to prevent this in the future? Well, those alternatives that they've created are so popular because the costs remain constant. Again, most of the increases that have happened are probably have already happened. But with that being said, costs could increase, and that is a risk. And unfortunately, we don't have a crystal ball here. So if you're really concerned about increases, then you want to go with one of those life insurance-based alternatives. All right, what happens to long-term care if I go into a progressive living facility? So if we're talking about an assisted living facility, you're probably unable to do 2 out of 6 activities of daily living, which means you would be qualified for the benefits for your long-term care policy. And those benefits would pay to the long-term care facility, to the nursing home, or if you meet the need, to the continuing care retirement community. Is this a policy that can be borrowed against? So traditional long-term care, the answer is no. The answer is yes for some of those life insurance-based products. Now, with that being said, well, just because you can doesn't mean you should. In most cases, because you're trying to generate the biggest bang for the buck, I would advise against purchasing a policy for the ability to borrow against it in this particular case. How are payment amounts determined? Based on gender, based on age, based on health, and based on whether you're married or not, and based on whether you buy it together or not. 2 separate discounts on the back end there. All right, I'm interested in types, levels of coverage for various plans, as well as premiums associated with each. What I would recommend is give us a call. We will help you filter down to something that makes sense for you and your financial plan. The goal is to make this process as simple and, frankly, as mathematical as possible, and we can do that for you. So I think that covers all of the questions that were posed both during the presentation and after the presentation. If anybody has any questions, anything personal in nature, please give us a call, send us an email. We're happy to help in any way we can. So thank you very much, everybody. I appreciate you taking the time this evening, and I look forward to helping you in the future. Thanks.